An invoice is one of the most important documents in business. It's essentially a bill that a seller sends to a buyer, listing the products or services provided, their prices, and the total amount owed. Think of it as both a request for payment and a legal record of the transaction. Invoices serve several purposes. First, they make sure businesses get paid on time. Second, they act as proof of the sale, protecting both the buyer and the seller. And third, they help with accounting and taxes, because every invoice is a record that can be tracked and reported. Not all invoices are the same. Depending on the situation, businesses use different types of invoices to meet specific needs. The most common ones include the standard sales invoice, the Proforma Invoice, the credit note, the receipt, and the tax invoice. Each of these plays a unique role in keeping transactions clear and accurate. Let's take a closer look at them one by one. A standard sales invoice is the most common type of invoice. It's issued after goods or services are delivered, listing the items, their prices, and the total amount due. This is the everyday invoice businesses use to request payment from customers. A proforma invoice is not a final bill, but rather a preliminary estimate. It's sent before the actual sale is confirmed, giving the buyer an idea of costs and terms. Think of it as a quotation that looks like an invoice, but doesn't require immediate payment. A credit note, also called a credit memo, is used to reduce the amount a customer owes. Businesses issue it when there's a refund, a return, or a correction to a previous invoice. It ensures the buyer's account balance is adjusted fairly. A receipt is proof that payment has already been made. Unlike an invoice, which requests payment, a receipt confirms that the transaction is complete. It's commonly used in retail and everyday purchases. A tax invoice is specifically designed to meet government tax requirements. It includes details like tax registration numbers, tax amounts, and compliance information. Businesses use tax invoices to report and claim taxes correctly. A sale on account happens when a business sells goods or services but allows the customer to pay later. Instead of immediate cash, the buyer's obligation is recorded as an account receivable. This is common in business-to-business transactions, where companies trust each other to settle payments after delivery. A sale on credit is similar, but it often involves specific payment terms, like 30 days or 60 days to pay. It may also include interest if the payment is delayed. Invoices for credit sales clearly state the due date, ensuring both parties know when the payment must be made. As you can see, invoices come in many forms, each serving a unique purpose. From everyday sales invoices to tax-compliant documents, they all help businesses keep transactions clear, accurate, and legally valid. With these additional types, sales on account and sales on credit, we see how invoices adapt to different payment arrangements. Whether it's immediate payment, delayed settlement, or structured credit terms, invoices remain the backbone of clear and reliable business transactions. Thank you for watching, and see you in the next video.